So we are reapplying the same concept we had in Learning Unit 5. And you know, we really look at the manufacturing, right? And it is the same thing here again. It's going to be, again, through the manufacturing accounting. And so when we talk about accounting, you know the usual suspect, right? We're going to touch on some ledgers, sorry, as well as we're going to look at some key statements and only two of those, all right? But let's dive to the actual ledgers, right? So I said that this last week, and I'm just repeating what I said last week. And that's the reason why none of this should sound new, should sound confusing, because you know every single thing, right? We did make a distinction between a retail business and a manufacturing business, right? You know the retail business. You just buy finished products, right? You add a markup and you sell it. That's all. It is as simple as that. You buy and you sell. You buy and you sell. You're just adding a markup, right? That's not the same with the manufacturing. You know that basically you are creating an entire value chain, right? Um, and that's the reason why we must account for every component, every hour of labor, every factory expense that transforms the raw material, the raw materials into a finished product. All right. So look again at this picture. You recognize the usual suspect. You know them. How do I call them? The three Musketeers. You know them. You know what I'm talking about. It's direct material, right? It's direct labor. It's manufacturing overhead. And I always repeat this to you, even when you are sleeping, right? Even when you are sleeping, if they ask you, what are those three? You know what we're talking about, right? So you have the material, obviously, it could be anything, but we know that these, if we aggregate them, I don't think maybe that could be the correct term, right? So, but they constitute the input. If these are transformed, at the end of that transformation, they would be out. You know it super well, right? Right. So they are the three ingredients: direct material, direct labor, manufacturing overhead. And you're probably saying, you've repeated this, I don't know how many times. Do we really have to do this? And that's what I'm saying. Finance is only few principles. And if you grab and understand clearly those few principles, there is no way you can fail finance, because the rest is just applying those principles. That's all, right? So the cost of raw materials that are one of the important aspect of this learning unit is that we need to understand the traceability of these things. So we are different in finance, is that we want to put a value into everything that we used. And that makes it good accounting, isn't it? That's the purpose of actually manufacturing accounting. That's the purpose of it. We want to account for everything. We that don't want to just, especially when you're dealing with investment, large amounts, you can't always be looking at an average or a ballpark. That's not really good financing, right? So the cost of raw materials that are directly used in the manufacturing of a particular product, that's your direct material. Examples, be anything: leather, wood, flour, cement, and all that, depending on which business, right? Direct labor. Those are the employees or the wages of those who are directly involved into the manufacturing of the product. You know that, right? So factory workers, bakers, shoemakers, always make sure that whatever question you read carefully, and that's what we are bringing in you, a skill of reading clearly and understanding what are we really talking about here. So if you have another worker who's not part of the manufacturing, and you are dealing with the question on manufacturing, you know where to put that, where to sort of categorize that, right? That will not be under manufacturing. So direct labor, and we have manufacturing overhead. What did we say about manufacturing overhead? We said anything that is not direct material, that is not direct labor. That's what we said. So what are we talking about? We are talking about everything that is indirect. But even though it is indirect, it is essential for the manufacturing. What are we talking about? The supervisor, especially if that supervisor is working on the factory floor? Yeah, for sure. He's directly involved. No, no, so he's in the manufacturing, but is not touching the product directly, but is involved in the manufacturing. So a supervisor. Then say cleaners, but the cleaners, they are not touching the product. Yes, yes. That's the point. There are cleaners in the manufacturing plant, but they're not touching the product. So it is an indirect cost, right? So I saw, for example, the quick question 2 for task 2. In majority, most of you did well, but there were still mistakes that you were making. And that's the reason why, and you know what it's so what is very bad is that that mistake, that one error will false your totals. And the next questions that depend on that question will be wrong. So people who got question 2 wrong, or I think question 3A, yeah, question 3A, those people who got that question wrong then got question 3.2 or 3B wrong. So you have to be careful, especially in the exam, right? Depreciation. It's not something that you see, but it's a real thing. Depreciation of equipment. We are using equipment. We are using them up. That's the reason why equipment need maintenance. But why? It's because we are talking about the depreciation. So be careful with all those things. And depreciation would be, by the way, what would it be? It would be an indirect cost, not a direct cost. All right, right. So I like this because this now gives you the full picture. And I hope the rest now will now flow easy, right? So for our accounting blueprint, we're going to be dealing with the direct material account. We're going to be dealing with the three musketeers, right? Direct material account, direct labor, and manufacturing overhead. And you can see them pointing to the working process. This is where the actual manufacturing takes place. I love to call it work in progress, but it's the same principle. Work in process. All right. So once this is done, so once the product has been manufactured, then it moves to the finished goods account because it is finished. The manufacturing is over. Now it moves to the finished good account. And after it moves to the finished good account, then it moves to the cost of sales account. Is this making sense? This, do you see this flow? Always this easy flow in your brain. Is this making sense? All right, so now let's deal now with an actual ledger. And you can see it in front of you. Let's use the example of a direct material ledger. Remember, it's a ledger, meaning there will be a left and a right, and we have a balancing that we have to do. So you know that. You know, imagine a scale, right? You have to do the balancing act, right? I love to use the term sifting. You are sifting. That's all. Many would think about it as a balancing act, but I would think about sifting, right? Well, you're trying to uh, remove what is not there, what should not be there, and you are only retaining what should be there. Do you get the picture? All right. So everything starts with raw materials, uh, directly, material, general ledger. Count tracks the value of materials we own. So we bring in materials. By the way, when we bring in material, what is that called? Do we credit or do we debit? So you can see that the material came in. The material came in. All right. All right. So we will go to that. So we debit this account because it's a plus. We get plus. And obviously, remember in your ledger, you will get your generally in your ledger, you will get your debit on your is it your right? Uh, on the screen when you're looking. And again, it's where you're looking. So if you're looking directly at your screen, this will be your left, this will be your right. Do you see that? Left and right. Okay. I know you've done your accounting, but I'm just trying to make you understand this plus minus all the time. Plus minus all the time. But you will get it much more easier here. So we debit this account when we buy materials. So we debit and we credit when we send those materials to the production. And can you imagine that accounting is so precise that it captured the whole process on a piece of paper? That's the beauty of the ledger, is that you will have your trade payables, the bank, definitely you made cash payment, trade payables, you took things on credit that you are going to pay later. All right. So, but one thing is very important is that for all these accounts, remember that a year, a period, a year is not isolated from previous years, is not isolated from the future. So this current year, 2026, when we are dealing with 2026, we will deal with some stuff that came from 2025. And everything that we are going to leave or we are going to not use in 2026 will be used in 2027. That's basically this that you are seeing here. The opening balance means that there was material that came from 2025. We're not going to throw away that material. We're going to use that material and bring it in. So it's an addition. But what we are not going to use this year, what will be the leftover, that is something we need to subtract. And that's why I told you, it's just sifting, sifting, sifting. So here, what we want to find, the working process here, is basically we add up everything. So the opening balance plus what we bought this year will give us a total. This total, though, we need to remove from this total what will be left over, this amount here. And if we remove this amount, that's what gives you this that is remaining. Only will include what we used this year. This year. Is this making sense? So I want to hear from you because I don't know your accounting, if you've done accounting or not, if this is confusing or not, but I can assume all of you understand this so clearly. All good. Right. So Sorry that I wasted your time, but it's like that. I just want to make sure, remember, I'm doing this even for the one who's really struggling, right? And who might be shy to say that they're struggling. But this, that will be the work in process. So on your right-hand side, you will have what we're going to send to, yeah, sorry, what we're going to send you. Remember, we need to, material came in, material will go out into the work in process. Labor came in, labor will go out into the work in process. Manufacturing overhead came in, manufacturing overhead will go out into the work in process. Trust it makes sense. All right. So stage two, right? So now we are talking about the main account. It is the main account. It is the main man, if you want to. I sometimes use these simple terms to remind myself what I'm talking about. Manufacturing, right? The main man is the work in process. It's where the actual work is happening. And what is happening there is that we have the direct material, direct labor, and manufacturing overhead that are going to be the input, right? So the work in process account is the most important account in manufacturing. Think of it as a bucket that collects all the costs associated with products that are currently being manufactured but are not yet complete. Very important. This is where the manufacturing is happening. That doesn't mean that the manufacturing is done. And as you can see here, you can see the direct material. You see this direct material. It is here on your left-hand side here. So it's being debited, meaning it's being added, debited, added, credited, deducted, or removed. It's a minus. So it's being classed. Let me make it simple. It's being classed this side. Do you see it? And look at this amount here. 384,000. Do you see it? Isn't it this? Do you remember this? After we did the sifting, after we did the balancing act, do you remember this amount? What is this amount representing? Did I tell you? It's what we are going to use this year minus this amount that we're not going to use this year because this amount, 174,000, is going to be the leftover for next year. That's all. So we are more interested, you see, we are more interested in what is going to take place this year. That's all we are interested in. Can you imagine that accounting is, we are accounting for what is happening this term, this year. That's all it's about. So don't badmouth accounting. It's very simple. It's just we are more interested to know exactly what is happening this year. What on earth is happening this year? And obviously, with the work in process, you will always have also a timeline. We are talking about the work in process for 2026, but we have also work in process that was in 2025, the previous year. It was not completed. The work was not completed. So we need to continue that work this year too. So that's the reason why there is an opening balance, and there would also be a closing balance if it is provided to you. Read the question. If they say that there is a closing balance, okay, that should be okay with you. But you understand what closing balance means? Is that we're not going to use it this year. That's all. Simple as that, people. And now, allocating manufacturing overhead. Remember, we dealt with direct material, direct labor. Now, what about the manufacturing overhead? We're also going to add them up, all of them together. All of them together. That would be your indirect labor, for example, your supervisor or your cleaner, your indirect material, that could be maybe the glue, Maintenance factory, we understand. What about electricity for the factory? Electricity for the factory? Yes, we will take that, right? It's indirect. Depreciation, we will take that. Rent, we will take that. It's not, rent is not the actual manufacturing. Yeah, but we understand that. Are we all good here? Because you look, so we go in, it's coming in, it's a plus, and when we remove it here, it's a minus because we're going to take all these and send it, remove it from this ledger, this account, we send it to the working process. That's all is happening here. It is a flow from one account to another, and there is a progression. Making sense? Are we on the same page? Guys, now you're scaring me. I don't know if you're all awake. All right, all right. Tammy is there. Nick, are you there? I'm just scared when you're not, some of you are not saying anything. All right, but okay, so let's move on. Now, the complete picture, right? The total cost of production, really, the total cost of production, the total cost of production we will look very intently at this particular account, the working process, because it speaks volume, right? Because it's the actual manufacturing. Remember, I told you it is the main man. With all the three ingredients added, the debit side of the work in process account now shows the total cost invested in production for the period. So we can see now, this is all that came for the production. We can see, here it is. So we can see this is the total that came for the production. The next step now is to calculate the value of the goods that were completed. Just because something was being manufactured, that doesn't mean it's complete. So where do we go now? We go to the finished goods. And again, beautifully, the same progression as always, right? From one side to another, from one side to another. So on the debit side here, remember what we're going to, sorry, on the credit side, we're going to now credit the finished goods here. Remember again, I told you work in process always needs to look if there's a closing balance. And this is a closing balance. So from the total of 1 million, we need to find out, is there a closing balance? Did they provide us with a closing balance? And if yes, we need to put it. Because this total minus this closing balance, I said it's not for this year, it's for next year. Get rid of it, all right? What you are left with is only what was manufactured this year and completed, basically. So we have, this will be the finished goods. So this came in, it goes out as finished good. It came in, it goes out as finished goods. And that's the reason why we send it to the finished goods. Does that make sense, guys? Are we good? All right. So from the finished good, do you have an idea what else could come after the finished good? Obviously, if we finished, we need to sell. And that's where a very important thing comes in, the cost of sales. But you must remember now this. It is the cost of sales of goods sold that really, really is important. Because you can manufacture and finish to manufacture products, but that doesn't mean just because you manufacture them, automatically they are sold. No. So you need to make a difference between finished goods manufactured and finished good sold. Does that make sense? So when a finished product is sold, its cost is finally recognized as an expense. And remember, we talked about this. We talked about the manufacturing, right? Remember, I was telling you about the inventory. I told you last time, I say, on the two statements, the income statement and the balance sheet, which one are important with regards to this tracing? Remember, what was the answer? I said you need to look at the finished goods, at the cost of sales, which is on your income statement, cost of sales, and you need to look at the inventory, which is on your balance sheet, right? Remember, on the asset, on the current asset, inventory, you need to look at these two. Very important. Ciara, question.
Hi, sir. Can I just ask if you can go back one slide? I have a question. I just want
Right.
to make sure.
It's here.
Is the finished good the it's supposed to be debited, the work in progress
No, no,
like
it's
amount?
debited. No, forgive me about this. Actually, this, remember, this is a presentation, but the real deal, let me, can you guys see this? Are you seeing your OneNote?
No, sir, yes, we can see it now.
Yeah. All right. I have done this for you about, yeah, this progression is here for you to help you. In fact, I've put one horizontally and another one vertically. Right. So when you go from the finished good, right, from the finished good, you can see that the work in process is coming on the debit side, like Ciara said, right? So, but when I was presenting, obviously, yeah, it didn't work out quite well, but it's the same principle because what will come out from this will also go to the cost of sales, right? So please look at this ledger. And that's the reason why you need to do an example to be able to see. Do you see the finished good? Do you see the work in process? All right, guys. So relax, but this will tell you, it tells you the work in process will go, yeah. Right? Does that make sense, guys? I'm just touching on the principal side here. So this, Ciara, is 100% correct. It should be here. Should be here, right? But some reasons it didn't go the right way. Right. But now, from the finished goods, the next progression will be the cost of sales. Because some of the finished good will be sold at one point in time this year. And if they are sold, they need to be moved this side. All right? So again, opening balance, closing balance. I'm not going to touch on that anymore. You know that, right? But the purpose here is to show you that always think about that progression from finished good. We now go to selling itself. And we need to find out what was really sold. And if we found out what was really sold, one way to put it, there is two other accounts. I'm just going to joggle again here. Look at the cost of sales and the trading account. And you can even progress from the trading account to the profit and loss. These are also ledgers that you can use, depending on the question. Because the trading account will put together the cost of sales of finished goods sold. Remember, I always repeat that finished goods sold, that's the actual cost of sale. Finished goods sold versus sales. So we will look at our sales versus cost of sales. But what does that tell us? Sales minus cost of sales. What is that? What does that give us? gross profit, profit. So that's the reason why there is this profit and loss account. It's basically just to see, are we making a profit or are we making a loss? That's all. Do you understand the progression of these ledger accounts? Does that make sense? So it's only a few of them, but they are very logical. From manufacturing to finished good, from finished goods to selling them, from selling them to putting the cost of sales versus the sales, so that we can see if there is a profit or a loss. So you can't tell me when you are doing your practice, you don't understand this. And if you are asking the exam, do you really need to memorize this? Because you don't need to memorize this, right? Because it's logical. And that's what I'm saying. It just takes you to study also. After, obviously, this session, please go and do your due diligence. I want to touch on those two statements I was telling you. So we're going to have a production cost statement. Why do we have a production cost statement? It's because you're not going to deal with ledgers like this. You yourself agree that these are very loose recording method, very loose. We want something that can provide us a quick dashboard of everything. And that's why from general ledgers, we use production cost statement. Statement sound very financial. So the production cost statement is a report, and it distills all the activity from the manufacturing account into a single powerful summary. But for when? For the current period. Always remember that. We are accounting for the current period. All right? It answers one key question. What did it cost us to produce the finished goods this year? What did it cost us? And you will see this. This is an example. I love these examples, and I hope it's really helping you visually. But let's look at the production cost statement. What is happening there? You have the direct material cost, you have the direct labor cost. That reminds you, right? Those three, who are they? The three musketeers, right? Direct labor, direct material, factory overhead. You need to put them here. You have those totals here. You have the total manufacturing costs that you will obtain from adding them up together. But remember again, you always plus the opening balance and you always minus the closing balance. Why do you minus the closing balance? Oh gosh, if you can answer that question, I'll feel so good. Why do you minus the closing balance? Guys, are you there? I said you minus the closing balance because it's not about this year. Closing balance, it's the leftover. It's for next year. And I said that quite simply. Exactly, Denver. Thank you so much. Guys, come on, come on. Wake up. Did you take your coffee? Just kidding, guys. But please pay attention to this because you see, in an exam, when you things that are so basic, you're struggling with them. In the exam, you're going really to have a pain in your neck, right? So be careful with that. Just make sure. Remember again, for a statement, you're not gonna use the ledger. You're gonna use note. Oh, that's beautiful. Note. So notes, you can write them quickly. Why do we teach you this skill? So that you can make quick calculations. What is my opening inventory for direct material? Meaning what came from last year. All right, I have this. It's 21,000, right? I write it down. What do I need to plus? I need to plus everything that I'm going to buy this year, the net purchase for this year, minus again what? Closing balance, because closing balance will be the leftover. And that provides me the direct material. And that was the direct material used here. So from your notes, we can ask you the question, could you draw up the notes? And the note, we just want you to do something simple. Plus, minus, that's all. But there is this note number 4. Remember that the 3 notes is for what? Direct material, direct labor, manufacturing overhead. But note number 4 is a very important note that I want you to know about. Because it's what I said again, just because you manufactured product doesn't mean that they are sold. You manufactured 10 shoes, right? 10 of them, 10 pair of shoes. You manufactured them, but you only sold 7. What is remaining is 3, and that 3 is for next year. So you always need to start with the opening inventory, meaning that maybe some shoes came from last year. So you have 5 shoes from last year, and this year you only manufactured what? 5. 5 plus 5 gives you 10. Minus 3 that you were not able to sell because you are not able to sell them. Why are we doing this? It's because we want to extract the cost of finished good sold, not manufactured, sold. Because not all that is manufactured will be sold. Right. So basically, that's what we were covering. I have about 7 minutes and I want to touch on. So now what you do, this is a presentation. You understand some of the principles, but you need to practice. That's why you move quickly to your OneNote, because your OneNote will provide you things like this, providing you clear depiction. This is your direct labor, direct material, factory overhead. It comes on the debit side. On the credit side, you will have a finished good. From the finished goods, you draw a ledger, and then you will put uh, the working process. Do you follow how it's going? Do you follow how it's going? Very simple. All right. And so practice example 1. If you say, but how will I know where to put what? No, you can't ask me that question because I've provided everything for you. I've shown you where you take this amount. And that's the reason why before even you do this example, you can try it on your own and struggle by yourself. And then say, okay, but where did they found this amount, that amount? Then you come here to your OneNote. Your OneNote will show you directly with an arrow where this goes. In fact, it's a mini lecturer. It's a mini lecturer for you. So everything is here. Everything, everything, right? What I wanted to touch is on the statement. Remember the statement, yeah? I told you there were 2 statements that we deal with, 2 little statements. There is the production cost statement that we've just covered, and there is the trading statement. Trading statement is just basically does one thing. It says sales minus cost of finished goods sold gives you what? The gross profit. That's all it does. It is as simple as that, right? Does this make sense? So these are the 2 little statements. You can't fail them in an exam. The difference, the example I gave you right now is here. This is the example I gave you. I say you need to look at note number 4. Note number 4 for cost of finished goods sold. Because the cost of finished goods sold is the one that you're going to use in your trading statement. Production statement, trading statement. Production statement will give you the cost of production of finished goods. So all that was produced, all that was manufactured. These two things are different. So now I just want to hear from you. Does this make sense? Guys, you can't go wrong. You really can't go wrong. You get a question like this, you make sure you kill it. Easy. But, and that's what I'm saying, please practice, because you don't want to be wondering, what is the production cost statement again? Guys, and that's the reason why the marking is brutal for people who are not taking seriousness. I'm sorry to say, because it's clearly laid out in front of you. So you have no excuse when you get into exam and say, oh, maybe I didn't memorize it. You don't need to memorize it. You do not need to memorize. You just need to understand the progression. Right? So that's it for this evening. I open the floor to questions that you may have. Do you have any question or maybe a comment that you have? And if not, that will be indication for me to stop at least the recording. If you would like to stay at the end of the class to have a quick chat with me, that's also very much welcome. But is there any question? Going once, going twice, all good. So I'm stopping the recording because the reason why I always rush to stop the recording, is because I don't want to give you very long recordings